First thing, no matter if it's a traditional, when I say traditional, I mean just a regular ETF like the S&P 500, the Nasdaq, right? I'm not talking about dividends or income, but no matter if you're looking at traditional, a commodity, income, or dividend, the first thing I look at is the price return because that is what matters. Your price return, aka your NAV. You ever hear me say NAV? That's what I'm talking about. That's the first thing I look at. If someone throws a ticker at me, I key it in real fast and I look at the NAV because I want to know what that does by itself with no dividends or no income over time. That's the first thing I look at. And if it doesn't look good compared to the S&P 500 or one of its peers, another ETF that's similar, I don't worry about it. That's it. I don't care. I move on. If it doesn't even matter. If it does meet those criteria that I like what it's doing with the price return, then I look at the expense ratio of the fund. Then I look at the dividend yield, and then I go under the hood. Then I look at the holdings underneath, and then I will go do a comparison check and compare the actual holdings to that ETF to one of its peers or the S&P 500 to see how much overlap there might be to the S&P 500 or to another one of its peers. And then from there, if I like it, I might just track it for a while. I'll key it in to my watch list and keep track of it for probably 3 to 6 months and see how it performs compared to one of its peers or compared to the S&P 500. That's how I look at ETFs and break down ETFs because we have a problem now, and it's very tough. We have so many new products coming online every week where it's a new shiny toy to people where people say, oh, I've got to have this thematic ETF. And they just get into something. They don't know how it's going to run. They don't know what's under the hood. There's no past performance. You're just trusting this portfolio manager to make the right decisions with your money. And that could be a very costly mistake. And it's not just for people with a lot of money. It's for people that are just starting out. If they have $500 or $1,000 and they get involved in something they shouldn't and they lose, 30 or 50% of their money in 2 or 3 months, that is devastating. And they might take the rest of their money out of the market and say, hey, the stock market's rigged. It's only for wealthy people. And that's it. They've lost. They lost it. And then they'll never get back in the market. I've had that happen to plenty of people I've read where people said the same thing. So it's very important to do your own research. Like I said, do all those steps, look under the hood, and don't get involved with stuff too early. Let it track. Make sure it's a safe investment because there's no reason to get in a hurry to get into anything because there's always times on your side when you have money because it's not going to go anywhere. And a kid in the candy store, I know it's hard to just sit on the sidelines sometimes, but just track them like ETF tracker. That's what that guy does. I know he's in here somewhere. No, he's not even in here. Where's that ETF guy? He's a tracker. But that's my answer, digital. Hopefully that helps some people out.
Yes, sir. I appreciate that a lot. And by overlap, you're talking about each ETF in the amount of exposure they have to individual companies, right?
Correct. And there's an actual website. You can type it in. It's on ETF. Oh my gosh, research, ETF research. And there's an overlap section, and you could type in like the S&P 500, whatever. You have to have the two tickers and QQQ. And you can key both of them in, and it'll tell you the overlap of what stocks they have in common between those two. So with the S&P 500 and the NASDAQ, there's 56% overlap. Okay, because I had somebody yesterday tell me there was 98% or something like that, and I had to call them out. I'm like, no, it's not 98%. Hold your horses, buddy. Here's some facts. But yeah, and that's a free website, and you can go there and do your research on that. It's really neat to do because you can say, okay, and then it'll even show you the breakdown of the 11 different sectors and which ones are, have the most allocation to, let's just say, technology and energy. It'll break all that down too. But yeah, it's a very cool way to look under the hood and compare ETFs. It's ETF research.
Yes, sir. I appreciate that, man. No, that was perfect. I appreciate that, man. Yes, sir. Where's that board at? There it is. There we go. Yes, sir. I knew you'd like that, man. So, hey, Elijah, can we have you go ahead and break down the same thing? Three things you look at.
Yeah. For me, I look at the price return. I don't really care so much for expense ratios at this point because most of the expense ratios are kind of a little high nowadays, unless you're really going for some growth. So it depends on what you're looking for. But and then for me, kind of if it's tracking Nasdaq, the Russell, SP 500 is also what I look at. So those are my three main things. Far as growth, that's what I look at. And then if it's like income ETF, still the same thing too. Expense ratios, I'm a little looser around. And then eh, price return for sure with NAV and all of that as well too. And then those are, yeah, probably my three main things that I look at personally. And then also who the issuer is, because some issuers you know what you're gonna get. So like I kind of stay away from like D Finance, Yield Max, and all of those guys because I know they're not the greatest when it comes to um their products being kind of, the best or solid. But I keep mine pretty simple, and then I just look at their prospectus too as well to look at some other stuff that people don't highlight. And so that's like how the ETF functions, what's underneath the hood. That's how you go deeper within outside of looking at charts and stuff too. And you can look at how things are taxed as well if you look at the prospectus. And so that's what I mainly look at, and just what I'm just looking at long term, what I want to get out of things. And so I'm pretty simple when it comes to the things I want.
Hey, I appreciate that, man. No, that was a beautiful explanation. And so, what is like a red flag, like an immediate red flag for you when it comes to like digging into ETFs that make you like start reeling it back?
For me, a red flags would be kind of like promising a certain amount of yield. I really don't like how some of them nowadays are kind of promising a lot of yield on nowadays. So like they'll say, hey, we'll give you like 26%, 30% or whatever of whatever kind of price that we're sitting. I'd rather a fund manager just be kind of straight up and also just kind of balance out between trying to force the yield. And so some of these ETFs, they kind of promise you and try to hold on to like giving you that 20% when sometimes it just hurts more than helps. So kind of like looking at guarantees I don't really like from ETFs. And also yeah, that's pretty much about it. 1998. And so, yeah, for me, I think that's about it. Kind of the guarantees. What are they guaranteeing? How are they guaranteeing it?
Hey, I appreciate that, Elijah, man. You killed it, bro. I appreciate that. Go ahead, John.
I had to add another thing that I forgot about. Another thing that's important that I look at is the actual assets under management for the ETFs. And you might have a problem with this if we circle back and we're talking about newer ETFs or less popular ETFs, where if you're looking at Schwab, like SCHD, and you go to their fund, they have $109 billion invested in that fund. $109 billion. That is liquid. That means you get a very good bid and ask. If you're doing a limit order, you can type in whatever you want close to it, it's going to get filled, right? You're not going to lose any money on those big funds like that. If you have a newer fund, and I know I have one pretty new. Oh, well, let's look at BLOX, even though it's popular. Let's look and see how much money is in that fund now since it's been. And of course, the total assets under management goes down when the price goes down a whole lot. Don't forget that. So Blocks has 284 million. So that's not really too bad. I really only like to get invested in the ETFs if they have over 500 million. And I know some people had horror stories this year because we've had a lot of shutdowns on ETFs, and you get an email saying, "Hey, this ETF's going to close. We're going to liquidate everything and give you your last price on this last trading day." And that's what happens to some of these ETFs. I call them fly by night ETFs, the ones that never get any volume. You've got to have, I believe, over 75 million starting out over the first 6 months or 8 months to make a profit. And then after that, you've got to continue to grow that for most of these places. So if they don't get that initial money and growth, then they're going to have to shut down their funds. They just can't run on fumes. So that's usually something I look at is your asset under management. Make sure I like to have at least over, I like to have 500 million starting out. And the good funds, even if they're brand new, a few months old, just watch them track, and you'll see every 2 weeks when they file, you'll see that start building up and building up. A perfect example is the Goldman Sachs ETFs. It did not take them long at all, and now both of them are massive funds. They're both over 10 billion each. Last time I checked, hold on. Yeah, I mean, that's what happens when you have quality, you have good funds. They're the people that's going to, yeah, GPIQ has $5.5 billion in it now. And GPIX almost has the same thing. So that's very liquid too. And so that's another thing I look forward to is see how much money is invested in these funds. So wanted to throw that in there too.
Hey, I appreciate that. That's definitely good stuff to know. I appreciate that, man. See, that's why we got who we got, man. Break it down the proper way. All right, now let's go to dissecting. What up, dissecting, bro? Let's get your take on these ETFs, man.
I mean, John Elisha just nailed on everything, but to add to that, usually if there's like a trend that I'm really bullish on, like let's just say I'm bullish on the aging population. So I'd find an ETF that's either like focus on, extending longevity of people, or even like an ETF of healthcare providers to profit off of the growing healthcare spending due to the aging population. So things like that. When it comes to income ETFs, the expense ratios tend to be very low, like around 1%, maybe even like 1.5%. But because my dividends are like 10+%, so that's why I don't really think much about the expense ratios. But we're lucky. We have so many different ETF options for different things that they could be used as both trading instruments, investing instruments, like you name it. It's not just S&P 500. So yeah, just keep that in mind. I will say for international, you do want the currency hedge options, and there are not much of them because of there's just not much popularity, not much demand. But if you're gonna look to invest in a country like Japan, for example, the currency hedge version of it has drastically outperformed the normal like Japan ETF simply because the hedge version helps ensure that your assets don't depreciate by that country's currency's depreciation. So yeah, it's pretty cool. A lot of new options today, a lot of things to think about, but it's never been a better time to be an investor.
Bro, hey, you nailed it too, bro. I really appreciate that. And another thing you nailed it on is it's never been a better time to invest, man.